Hello and welcome to All About Your Company. Today we're going to be talking about EPAC Durable and why is this one in focus? It's an interesting time for consumer durable stocks. One, the summer has come in a far sharper way than what most were anticipating. The monsoon is not going to be as strong as, again, the long period averages. And what we're seeing is commodity costs are elevated, and therefore it's a very mixed kind of an environment. In fact, last 12 months, you can see that the stock is down 22%, but the last 1 month, the stock is actually up 27+%. So you've seen a very mixed kind of reaction even on the stock in the near term versus the slightly medium term. It was a very tough year, FY26 overall, for some of the consumer durable companies. And EPAC obviously is a manufacturer for them. Therefore, this one in focus. We'll try and again take a step back, try and understand what the company exactly does. Let me quickly pull that piece up. It operates in the consumer durables industry. It designs and manufactures AC and home appliances. Incorporated in 2003, listed in Jan 2024. Market cap is roughly 2,700 crore. Promoter owned. The Singhania family is one of those. And we will be speaking with Ajay Singhania, who's the MD and CEO at EPAC, in just a few minutes from now. Let's quickly try and sum up everything that we need to know. Products, first and primarily room air conditioners. They do split and window models. Small domestic appliances, what they ventured into to try and diversify. This has been a smaller component. In fact, FY24, if you see the split, 80% plus was still room ACs till 2024. In fact, the real change has only happened FY25 onwards, and we'll take a look at that. And small domestic appliances was just 19% in FY24. Within that, you can see some of the products: induction cooktops, mixers, grinders, water dispensers. You've got air fryers, nutri blenders, infrared cooktops, coffee makers, and machines, and dry vacuum cleaners. They're into all of these. In terms of large domestic appliances, they are into desert air coolers, they are into fully automatic washing machines, and they are into and they're coming up with semi-automatic washing machines as well. In terms of components and sub-assemblies, that is also something that they do in terms of a product line. They have plastic molded parts, panels, fans, enclosures, sheet metal parts, heat exchangers, copper tubing, printed circuit board assemblies, which is PCBA, PCBA, and cross-flow fans for indoor air conditioners, universal motors for mixer grinders, brushless direct current motors, and this is through their JV with EPAC. That is, they are also into motors, which is something which this JV will focus on through the EPAC partnership. Let me talk about the business model. They're basically original design manufacturers. They design it themselves, and of course, with the help of their customers. I'll pull out the customer list as well, but along with their customers. And they do this for leading brands, design, source, manufacture, and test all of the products that their customers require them to, and thereafter sell the product to customer. Clients, well, key clients include Blue Star, Daikin, Voltas, Chroma, Havells, Haier, and Godrej, some marquee clients in that list. They also have a partnership with Hisense, and that partnership will likely start to would have already in fact started generating revenue in this calendar year. You're looking at key cost components, and this is where the key concern starts to crop up. You're looking at steel, copper, aluminium, plastic, electronics as some of the key components that go into what EPAC manufactures. The purchased parts which they generally purchase is compressors, motors, and specialized chips. That's something that they purchase. Employee costs and contract labor at plants is the other cost or part of it. Power, utilities, logistics, and depreciation. Now, power, utilities, and logistics costs likely to go up. Logistics likely to go up. Power, utilities already gone up. Interesting to see as to how all of this is going to play out on the margins for EPAC in an otherwise what's looking like a very strong year from a top line perspective. In terms of geography, predominantly India, just about single digit, very low single digit is export. So very, very strong in terms of the India presence versus export. Now let's look at the split in terms of product, and this is important. Around 57% of the product comes from ACs. Domestic appliances around 20%, 17% is components, and others is around 6%. Domestic appliances include small and large. This is a 9-month FY26. When you're looking at 9-month FY25 in comparison, 76% was ACs. When you're looking at FY24, 81% was ACs. And small domestic appliances and large domestic appliances also have gone up. In fact, components was just 6% of top line in 9-month FY25, currently sits at 17% of top line. So you've seen sharp increases on all of these products in terms of the mix. Now, let's talk a little bit about some of the components that go into it: heat exchangers, copper tubing, injection molded plastics, and PCB assemblies. That is also part of the components business, and that is something that they also use for their own internal purposes to manufacture the products that they manufacture and thereafter sell them to their clients. Now, let me take a bit of a step back, try and again understand what financials have done in terms of the last 3 to 4 years. In terms of the top line, it's gone up from roughly 900 crore to around 2200 crore, which is a very strong growth, around 33% CAGR over the last 3 years. EBITDA has gone up from around 70 crore to 155 crore in FY25, which is a 31% CAGR. Margins have been a little choppy. They've been between 7 to 8%, not major choppiness, but in FY26, we've seen a bit of a drag with regard to margins where they've slipped to the 6% number. Profit after tax is actually has seen a very solid surge of around 48%. This is up to FY25. FY26 has been a tough year for the company. What we've seen is a revenue degrowth of around 15% on a YOY basis. EBITDA has been flat. Margins have gotten better, FY25 versus FY26. Also, what one needs to understand is that the 9-month numbers, generally, the AC demand is stronger in Q4 and Q1, and therefore, those numbers need to be considered in that kind of manner. You're looking at a net profit which is just about single digit. Now, the margin trajectory I did show you, but let's quickly pull that one up again. Currently, margins sit around 6.3%. So we've seen a bit of a slip with regard to margins. Let's wait and watch as to how this unwinds going forward. Balance sheet, and if it does, or if there is a lag with regard to raw material cost pass-through. The balance sheet, around 1,000 crore in terms of book value. Currently, thereafter, you're sitting on around 2,600 crore in terms of your market price. And therefore, your price to book is 2.5 times odd broadly. When you're looking at your cash flow, when you're looking at your debt, that's the other piece which you want to really consider, and that's why we've given this one a neutral. Debt has been elevated, in fact, and we've seen around 690 crore rupees of debt sitting in the balance sheet in H1 FY26. Cash and bank balance of around 40 crore. Some of this is obviously inventory buildup. There has been that inventory buildup for a while now. Is the unwind happening? We'll try and understand that piece as well. Let's look at cash flow. And in terms of the cash flow conversion, it's been choppy. We've given this one a neutral as well. Inventory buildup, again, working capital requirements that the business has keeps this a little bit choppy in that sense, and therefore, that's something you want to consider. Also, the inventory buildup happens generally at the end of Q3 or at the end of Q4. So that is the other piece which hampers the numbers for the full year numbers when they come through, because that's where the inventory buildup has actually happened. In terms of return ratios, you've got sub 12% return ratios. You want to see a kick through with regard to that. It's not really happened. The reason partly is that they're getting into new product lines, and that kind of ensures that they're reinvesting the money back, plus working capital requirements are elevated, plus a couple of bad years, and that's played out on the return ratios. Of course, with the kind of diversification in product that they're doing, this should come down, hopefully, and return ratios should start to go up as some of the new facilities start to kick through and start to generate revenue for them. In terms of shareholding pattern, the promoters currently own around 47%. We're neutral on this one as well. FIDI is limited participation, but for a 2,600 crore market cap company, 7% DI participation, not bad at all. And then there's public, which owns the balance. But promoter ownership is just south of 50%. So that's one of the reasons why we've given this a neutral. Of course, steady in that sense. They've had to dilute to a certain extent, but otherwise steady. When you're looking at valuations, it currently trades at a 1-year forward price to earnings of around 35 times. The 2-year average is around 41 times. The 2-year range is between 25 and 78 times. So the 2-year range seems to suggest there's a long way to go. But we've seen a bit of a rally from the lows of 25 times, and we've seen a 27% increase in the stock price in the last 1 month alone. So that is something to contextualize. We've given this a neutral because it's a wait and watch. Need to wait and watch as to whether demand has picked up, whether EPAC is seeing that strong demand, tapping into it, and what the impact of the headwinds with regard to raw material prices is on margins. Let me talk about what analysts are suggesting. They too seem cautious. There are 8 analysts which track this one. All have a buy, no hold, no sell. And the average return expectation is 9% on this one, and hence we're neutral on that one as well. Let me bring on board Ajay Singhania, who is Managing Director and CEO of EPAC Durable, joining us this afternoon. Ajay, great having you. Let me start off by trying to understand what's playing out in the marketplace currently, both in terms of demand and inventory. You have a great pulse because, I mean, your clients probably place orders with you, so you'll probably be the first port of call. Give us a sense what's playing out.
So, good afternoon. Last 4 weeks, definitely the heat wave is playing out a big role, and we see a strong headwind again for an AC industry, which predominantly had been facing a slump for last 12 months or so. So after a bad season, I'll say things look extremely good. The order book is extremely strong, and right now the headwinds are very strong. The inventories are bare minimum. So all the price increase and what we were talking about has already been passed on. So I think we are in for a very definite growth in Q1 for FY26.
No, so you said pricing, the raw material prices, which at your level have gone up, you already passed it through.
Yeah.
And you've
So
managed to do that.
the entire price increase on commodities and everything has already been passed on to the brands, and probably most of the brands also have in part passed on to the market.
And is there a lead lag? So was there like maybe a period of 15 days, 20 days, a month or so where there was a lead and lag, or no?
So we follow a very systematic process when it comes to finalizing price with the customers. So we follow a quarterly system. So every quarter, whatever impact is there is passed on in the following quarter. So we have been following the system over the last 15, 20 years, and the same system continues.
But then that's a 1 quarter lag, right, Ajay? So is there going to be a 1 quarter lag this time, or at this time circumstances are very different and everybody wants those ACs?
So see, the price increase started dampening or impacting us from mid of Feb itself, and we were lucky that from mid March we were able to take some price hikes with the customers. So part price hike we already got in mid March, and then the balance in April. So yes, we have been able to pass on everything.
Okay, but there was a month where there wasn't a pass through. How is your contract structured, Ajay? I'm curious to know that. So does the contract state 1 quarter? Does it state 1 month? Does it state based on circumstances? Is it a cost plus? How does it work?
Typically every quarter. So every quarter we revise the prices, and we have been following it very religiously from both sides. So there is no lag as such. Every quarter we pass on the increase, decrease in the commodities. This being a special quarter, last quarter being a special quarter, we had some respite even in the mid, because there was a force majeure kind of a situation. But typically it's always at the end of every quarter we do it.
And Ajay, give us a sense, your AC obviously as a part of the mix, you've guided that it will go up to, or it will go down to 55%. It was at 57 in 9 months FY26, but it was also a year in which it was difficult to push out that inventory, right? Give us a sense whether there is scope for it falling very, very sharply in FY27. I'm trying to understand how the non-AC side growth looks at this point.
So for us, both are the growth levers. AC definitely we continue to grow, but what we have been trying to say is the other areas, the large domestic appliances and the small domestic appliances, components, everything is growing multifold. So the pace of growth for the others is definitely much high. And we have been trying to maintain a typical mix of, let's say, between 55 to 60% on AC and the balance on the other sector. So that's how we are trying to balance the overall portfolio. But yes, AC will continue to grow and others will continue to grow at a much faster rate.
And Ajay, tell us, how is industry inventory shaping up? How are your customers placed in terms of inventory? Is there very strong inventory? Is inventory getting exhausted very quickly? Is production ramp up being pushed out? Give us a pulse of that.
Yes, definitely. So as we are almost in the end of April right now, and the heat wave has already touched almost the entire India, north and west definitely are doing much better than compared to last year. So I'll say the inventory levels are currently at a minimum. I mean, they are at a very comfortable level, and especially because last 3 quarters the industry was suffering from an over inventory kind of a situation. So currently inventory are at the lowest compared to last 3 quarters, and in manufacturing ramp up has already started. So last month means April and May definitely look much better in terms of manufacturing scale up and putting the extra amount of material required in the trade.
Okay. And so one is on inventory, the other is on pricing. What are you seeing in terms of pricing trend? You've passed through a large part of the price increase. How much was that, if you can quantify it for us? And is there also a pass through by your customers to the final consumer? Is that what is playing out?
So for us, the price increase, then again, it's a very ballpark figure because it will vary from model to model. But typically, from Q4 to Q1, it's been roughly around 12 to 15% is the kind of price increase almost across all appliances, including air conditions and the small domestic appliances, which has been passed on to the brands. And in return, the brands also have passed on. They would have done it in multiple steps, but yes, most of them have already passed on.
Okay. And with regard to your margin, do you expect margins to expand sharply as a result of the kind of demand that you're witnessing? And does your growth guidance go up substantially for FY27 versus FY26?
See, compared to what we had faced in FY 25-26, I'll say 26-27 definitely looks much better as of now, especially with our efforts around diversification and now trying to show up results. We believe that definitely the growth in FY 26 is going to be much better. Both AC and the non-AC products are growing. We see a definite headwinds here, and margin improvement will follow through with better utilization. So our focus on the small domestic and large domestic appliances have been to kind of increase or improve our asset turn overall, and that we'll see definitely playing up in this current financial year. So that
So
will
what's
definitely
the
help us
growth
improve
number?
our margins.
So what's the growth target here? You've got around 1100 crore of top line from the 9-month period or trailing 12-month period, 1100 crore of top line from your room AC segment. How much does that grow by? Just give us a sense of that first off.
First of all, our results are to be released on 20th of May, so it will be very premature for me
No,
to give out any
absolutely.
numbers
I'm
right
talking
now.
about,
Yeah.
Ajay, I'm not trying to put you on a spot. I'm sorry if you think that way. I'm talking about 9-month ended December 2025, but the calendar year 2025, your top line coming in broadly from the AC segment was around 1100 crore. How am I doing that math? Around 57% of your 2000 crore in the last 12 months of top line that you've done, around 57 to 60% is ACs. So therefore, I'm trying to get to the number that you will look to achieve, say, in FY27. No Q4 guidance at all.
So FY 27 definitely yes. I'll say, I again repeat, ACs will continue to grow. I mean, after a bad year last year, AC we are seeing very positive signs of growth. I can definitely say some market insights here. I believe the industry should grow anywhere between 15 to 20% for this calendar year, and that would EPAC will definitely try to outgrow the industry. So 15 to 20% kind of growth for AC, and small domestic appliances definitely much more than that. So
And
that's the
Ajay, you
kind of
generally
broad
do,
industry outlook.
you generally, right. Please complete.
So I'm saying typically the industry is looking at a 15 to 20% kind of a growth, and we will outgrow the industry numbers for sure.
Yeah, I mean, you generally do 500 bips higher than industry. I mean, that's generally the trend that I've seen. You don't give solid guidance. But so therefore, around 25%, is that something that we can pencil in with regard to that number, with regard to room AC?
AC industry definitely we see growth this year at 15 to 20% growth for sure.
Okay, non-committal. With regard to non-AC, give us a sense with regard to how non-AC is doing and what are the levers there for growth. You're also doing new products there. What's the kind of growth number one can pencil in for FY27 or the next 2 to 3 years? Give us that visibility.
So next 2 to 3 years, if we look at the overall our product mix with non-ACs, especially the large home appliances, washing machines, we are seeing a very definite growth almost multifold growth. I'll say 100% growth year on year is because the numbers are currently very small. Same thing is what we are looking at with our component business and the small appliances, especially because we are increasing the product portfolio. So all three of them we are working towards a multifold growth. So it would not be like percentage. We are looking at multiple growths here.
Okay, and with regard to gross margins, you are able to hold on to gross margins both on AC as well as non-AC products, which is around 13 to 14%, my understanding of your gross margins on ACs. You can correct me if I'm wrong, and around 16% on the non-ACs. Both of those likely to sustain despite everything in terms of a headwind?
Yeah, definitely. Not just sustaining, we are looking at improving the overall gross margins here. And with all the kinds of price increase and everything, we are also working on rationalizing the output month on month. So like I shared earlier, we are looking at balancing the revenue every quarter, which will help us further improve the overall gross margin. So yes, definitely improvement in gross margin is what we are looking at.
Okay. And with regard to working capital, what's playing out there? Because that was one of the key drags for you over the last few quarters as well as even last year. Cash flow coming through in a more steadier fashion now. Inventory unwind has happened likely.
So a lot of inventory unwind has happened. I mean, not end of, let's say, Q4, but currently, yes, we are sitting at a bare minimum value of inventory. So all that correction, all that pile up of inventory, which we were carrying for more than 9 months, is currently getting liquidated very fast. And with the kind of headwinds we are seeing, we will be back on track in Q1 of FY27. So definitely everything normalizing Q1 FY27 is positive sign for us. And from here on, we believe that the growth, the kind of growth we were estimating last year, and this year put together, we should be able to again be back on track.
Ajay, Hisense in particular, that is a completely new growth lever for you. So if you're doing 15 to 20 on ACs, and then you're doing very, very strong growth, possibly very high double-digit, 50% plus growth on the balance non-AC business, then Hisense should further add to the top line. What is the kind of top line one can expect, ballpark, for FY27?
So our published numbers on Hisense day one was first 5 years of business. We are looking at almost $1 billion, that's roughly around 8,500 crores kind of revenue with Hisense in first 5 years, calendar years. This being the first year, and then plus 4 years, we are still on track to achieve 8,500 kind of revenue from Hisense alone with all their entire portfolio.
And the margins from the Hisense business are the same as your regular business, or do they enjoy a slightly, or do they enjoy some margin benefit from the kind of business that they give you?
Again, typically on a very broader level, they are almost similar with our existing margin levels.
Okay, understood. And with regard to Hisense in year one, so yes, the longer trajectory you've given us, the 5-year trajectory. Talk to us about year one. I understand that in Feb 2026 was the first month in which production started for you. What happens for the full year FY27 in terms of top line coming from Hisense?
So for Hisense, yes, we started the production end of March. Feb, we inaugurated the facility. March, we have started the production. We have already made the declarations. And first year being the first year wherein Hisense is trying to prove that it is a serious entrant into India market and is looking to grow itself as one of the dominant forces overall in the market. I think last 12 months, they have worked very hard to create the ecosystem, to create the channels, the requisite channel. So they've already worked for last 1 year to create the entire pipeline, the entire ecosystem for themselves. And for them also, this year is wherein they will try to get the brand established and then definitely look at multifold growth in the following year. So we are very positive that the kind of work they have done in the backdrop, creating the requisite channel, the pipeline and everything, I mean, it's tremendous work already done.
Point taken. With regard to margins and profitability, what's the target PAT margin now? Because what happens across cycles is your debt seems to start to go up in a bad cycle. Now, of course, that will likely come off. Give us a sense of what plays out with regard to the cash flow that comes in. You start to pay off debt. So what's the target PAT margin that you have with the kind of revenue you'll clock?
So overall, in terms of EBITDA level, if I talk about, we have always maintained that 7.5 to 8 is the kind of EBITDA level we are comfortable with for the next 2 to 3 years, and that's where we maintain. And in terms of the working capital, yes, that definitely shoots up whenever there is inventory pile up. But overall, if we look at the term loan situation, that's pretty much under control, and we have been paying out debts frequently. So working capital is something end of Q4 and end of Q1 is definitely when it looks to be at the peak because of the seasonal impact. But otherwise, broadly, yes, the inventories are in control right now, and we've already put systems in place to now control it further.
And therefore, ROC is to inch up possibly above 15%, and if so, when?
Midterm, so indefinitely, we have again maintained that in next 2 to 3 years, we are looking at a 15% kind of an ROCE. Currently, we are in a phase where we are growing very rapidly, putting up new facilities, putting up new investments every year. And like you shared, all the cash accrual is getting diverted into creating facilities, creating products. So this journey now currently looks that we've almost reached a scale wherein it's time for us now to start leveraging whatever investments have been done. So this year we'll see that we'll try to start leveraging on the investments done, and next year we'll see that leveraging starts to accelerate.
Point taken, Ajay. It's been a total pleasure speaking with you and getting this perspective. Thank you so much for coming here and speaking with us.
Thanks. Thank you so much.
Well, viewers, that's all the time we have on this edition of All About Your Company. Thanks so much for tuning in. More action on the other side. Stay with us here on ET Now.